They finally did it. For days, we warned that as the market approached monthly options expiry, the commercial banks would attempt one last desperate maneuver to protect their balance sheets. We warned that they would use volatility as cover to execute a liquidity flush. We warned that they would try to paint the chart blood red to convince you the bull market was over. Today, they pulled the trigger. On Thursday, January 15th, 2026, in a matter of minutes, the price of silver collapsed from its morning highs near 93 to roughly 86, nearly an 8% drop in a single session. Not over days, not over weeks, minutes. Let me be crystal clear about what you just witnessed. In a normally functioning market, a globally essential commodity does not lose 8% of its value in minutes unless something catastrophic has occurred. A major mine collapse, the end of a war, a technological breakthrough that suddenly floods the market with supply. None of those things happened today, not one. The fundamentals did not change. Industrial demand did not disappear. The Shanghai price did not collapse. No new supply entered the system. What you witnessed was not a market reaction. It was a paper raid. One of the most respected institutional research firms in commodities just released an urgent note describing current volatility as truly incredible. They're right, it is incredible, but it is not mysterious. This crash was engineered. It was a precision strike designed to trigger stop-loss orders placed by retail traders who chased the price higher toward $92. The banks can see those orders. They know exactly where the pain is. And today they drove the price straight into that pain zone to force liquidation. Why would they do this when they know physical silver is already tight? Because this is not about price discovery. This is about survival. There are billions of dollars worth of silver call options expiring this week. Bets that the price would remain above 90. The banks sold those options. If silver settled above that level, the banks would owe massive payouts, billions in losses. But if they could smash the price down to 86, even briefly, those options would expire worthless. The liability disappears. The premium is stolen. The balance sheet survives another day. This is not trading based on value. This is liability management under existential stress. And here's where the trap closes on the unprepared investor. When you see a red candle this violent, your instinct is fear. Your lizard brain screams that the rally is over, that you need to get out before it gets worse. The mainstream media will amplify that fear. Headlines about profit-taking, commentary about technical corrections, analysts declaring the bubble popped. They want you focused on the screen. Because while the paper price collapsed, something very different happened in the real world. The street price went up. We are receiving confirmed reports from physical silver dealers across the country that when paper silver fell 8%, the physical price did not follow. Dealers did not lower prices. Premiums did not shrink. They expanded. The real price held firm. That tells you everything you need to know. The drop to $86 is a phantom price. It exists only on leveraged exchanges in Chicago and New York. It does not exist where people exchange actual cash for actual metal. If you sold silver today based on that screen price, you didn't sell because of fundamentals. You sold because of a fabricated signal, and you handed your wealth to the very entities that engineered the move. The flash crash of January 15th will likely be remembered as the moment the paper silver market finally lost credibility. The manipulation became too obvious, too violent, and too disconnected from reality to continue working. Instead of scaring buyers away, this drop rang the dinner bell. Think about it from the perspective of an industrial user. If you are Samsung and you need silver for batteries, electronics, and solar technology, how do you feel seeing $93 yesterday and $86 today? You don't panic. You celebrate. You treat it as a flash sale. By smashing the price to save their options book, the banks have subsidized industrial accumulation, particularly in the East. They made silver cheaper for the very entities draining the vaults. They are burning the furniture to heat the house for one more night. And while the banks were busy painting the chart red, something historic happened in the physical market. Something that proves beyond any doubt that the 86 price is fiction. Ask yourself this: if the price of a commodity drops 8% in a functioning market, what usually happens? Sellers get desperate. Stores put up sale signs. Inventory gets dumped before it loses more value. But today, when silver dropped 8%, the stores didn't put up sale signs. They shut their doors. We have confirmed reports that the United States Mint, the sovereign manufacturing arm of the U.S. government, has suspended sales of the American Silver Eagle and more than 37 additional silver products. Read the official notice carefully. They claim sales were halted to recalibrate pricing amid surging demand. Think about how absurd that statement is. The spot price crashed. If the market were real, prices should be dropping. The mint should be flooded with cheap silver blanks from the COMEX. Instead, they're telling you they can't price products fast enough. That is a physical default at the retail level. The U.S. Mint operates on a cost-plus basis. They buy blanks, stamp coins, and sell them at a small margin. If they stop selling, it's because they can't acquire blanks at a price that makes sense. In other words, the paper price of $86 does not exist for the U.S. government. When the mint calls suppliers offering $86 silver, the line goes dead, and it doesn't stop there. Look at the private sector. Apimex, the largest precious metals dealer in the United States, has imposed a new policy that should alarm anyone paying attention. As of today, they've implemented a $10,000 minimum requirement for sellback orders and restricted pre-sale items. $10,000. That is soft rationing. By setting the threshold that high, they are effectively telling small savers to step aside. We only have time for whales. Why would a business turn away customers? Why make it harder to transact? Because they are overwhelmed. They have too much cash chasing too little metal. Their logistical systems are buckling under the volume of panic buying. This brings us to the most critical number of the day, the number that exposes the fraud. Across the country, dealers are reporting that the effective street price of silver, the price you must pay to actually take possession, is hovering around $120 per ounce. Let that sink in. Paper price, $86. Physical price, $120 spread, $34. That is not a market, that is a rupture. A $34 premium represents roughly a 40% markup over spot. In a normal market, premiums are $2 or $3. This spread tells you the spot price is no longer a valid reference. It is a legacy number used by banks to settle paper bets. It has no connection to the cost of the physical commodity. The banks can smash the paper price to zero. They can even make it negative. But if the dealer demands $120, then silver is worth $120. The flash crash was a gift to physical buyers, if they can find metal. The lower the paper price goes, the wider the spread becomes, and the faster the vault's empty. By driving silver to $86, the banks have created an irresistible arbitrage opportunity. Large players can buy silver on the exchange, take delivery, and sell it on the street for a $34 profit per ounce. That arbitrage will vacuum every remaining ounce out of COMEX warehouses. This is not speculation, it is mathematics. The exchange cannot survive this level of disconnect. We have the U.S. Mint halting sales, we have major dealers rationing, we have a $34 spread. This is what unobtainium looks like. Silver is disappearing into strong hands, into private vaults and industrial stockpiles. It is moving from the visible market to the invisible one, and the banks know it. The smash to $86 was not strength, it was weakness. A final desperate attempt to cover shorts before physical reality overwhelms the paper system entirely. And this is not the end. In the next phase, we will examine the Shanghai vacuum. While Globex crashed, Shanghai held firm. The gap between New York and China has blown out to $14 That number alone guarantees COMEX vaults will be empty before month end. The screen says $86. The banks want you to believe it. Don't. The banks just put silver on a fire sale for China. And China is buying everything. We've already dissected the manipulation on the paper exchanges. We've already documented the breakdown at the U.S. Mint. Now we have to turn our attention east, because that is where the true damage from today's flash crash will be felt. While algorithms in New York were smashing the paper price to $86 to save failing options bets, the Shanghai Gold Exchange sent a message that should terrify every central banker in the Western world. They didn't sell, they didn't panic, they didn't chase the drop. They widened the spread. Confirmed reports now show that the Shanghai silver premium has surged to roughly $13 per ounce over the international spot price. While Globex was flashing $86 on screens in Chicago and New York, silver in Shanghai was still trading above $100. Do the math. That is a $14 gap between New York and Shanghai. In the world of global logistics and commodities, a $14 gap is not a spread. It is a death sentence for the Western paper market. By smashing the paper price to $86, Western banks have effectively put the entire U.S. silver inventory on clearance for the Chinese industrial complex. Think about this from the perspective of a trader in Beijing. Yesterday, you were paying $100 an ounce. Today, the Americans are offering to sell it to you for $86. Do you think silver is crashing? No. You think the Americans have lost control, so you buy. You buy everything. This creates a vacuum effect. Every available ounce in London, every bar sitting in a vault in New York, every deliverable unit on the exchange is now being targeted for export. The arbitrage profit is so large that it covers shipping, insurance, security, and financing many times over. The banks believe they are saving themselves by smashing the price. In reality, they are accelerating their own collapse. If silver had stayed at $93, the physical drain would have been manageable. Slow, predictable. At $86, the drain becomes a torrent. They are incentivizing the very outcome they are trying to prevent, the rapid physical depletion of the West. This is what we call the paper trap. The more they suppress the paper price, the faster the physical metal leaves their control. They are trapped in a lose-lose scenario. If they allow the price to rise, they go insolvent on their short positions. If they push the price lower, they lose their inventory to China. They cannot win. This is why the Shanghai Premium is now the most important chart in the world. It is not a technical indicator. It is a desperation gauge. It measures how much more valuable silver is to a manufacturing economy than to a financialized one. China needs silver to function. They need it for solar panels, electric vehicles, batteries, electronics, and grid infrastructure. They treat silver as a strategic resource. The United States treats silver as a ticker symbol. Today's crash proves the U.S. market is no longer a price discovery mechanism. It has become a discount window for the rest of the world. And the timing could not be worse. This is happening right before options expiry. The banks are willing to sacrifice strategic national inventory just to avoid paying out a few $1 billion in call options. This is short-term survival at the cost of long-term ruin. But for you, the individual investor, this divergence is priceless intelligence. It tells you that the drop to $86 is artificial. It is not supported by global demand, because if silver were truly crashing, Shanghai would be crashing too. It isn't. Shanghai is holding firm, and that means the price must snap back. Markets behave like rubber bands. The further they are stretched from reality, the more violent the reversion. The deeper New York is pushed below global equilibrium, the harder it will rebound to meet Shanghai. What we are witnessing is a bear trap of historic proportions. Retail traders were shaken out at the bottom while industrial whales backed up the trucks. Do not put yourself on the wrong side of this wealth transfer. The $14 gap between New York and Shanghai is unsustainable. It will close, but it will not close by Shanghai collapsing to $86. It will close by New York ripping higher. The Shanghai vacuum is now wide open, and the sound you're hearing is not market noise. It is the sound of vaults being swept clean. Now we reach the endgame. If you followed this emergency breakdown from start to finish, you now understand the full scope of what happened today. You understand that the crash to 86.6 was a paper raid designed to save the banks from catastrophic losses at options expiry. You understand that the physical default at the U.S. Mint and the rationing at major dealers prove real supply is gone. And you understand that the Shanghai vacuum is accelerating the outflow of Western silver at record speed. The evidence is overwhelming. It is forensic. It is undeniable. Thursday, January 15th, 2026, will be remembered as the day the silver market officially snapped in half. We are no longer dealing with a single market and a single price. We are now witnessing two separate realities fighting for survival. On one side is the paper world. This is the world of COMEX, algorithms, leverage, and high-frequency trading. In this world, silver is $86. It is volatile. It is crashing. It is frightening. On the other side is the physical world. This is the world of the U.S. Mint, bullion dealers, Chinese industrial buyers, and long-term holders. In this world, silver is $120. It is scarce. It is rationed. It is unobtainable. The gap between these two worlds is $34. That $34 spread is the lie. It represents the degree to which the financial system is suppressing reality. But as we know from physics, pressure does not disappear. It builds until it releases. So how does this end? There are only two possible outcomes. Scenario one, the physical price collapses to meet the paper price. For that to happen, global demand would have to vanish. Samsung would need to stop making batteries. China would need to stop accumulating. The U.S. Mint would need to magically acquire millions of ounces overnight. Based on everything we know, inelastic demand, empty vaults, strategic hoarding, this scenario is mathematically impossible. Demand is accelerating, not declining. Scenario two, the paper price explodes upward to meet the physical price. This is the only viable path forward. The $86 price on your screen is a coiled spring. The more force applied to suppress it, the more energy is stored. And once options expiry passes, once the banks lift their boot from the market, that spring releases violently. We are setting up for a snapback that takes silver from $86 to $120 faster than most people can react. The paper market must catch up to the street price or the exchange ceases to function. This brings us to the final verdict for the individual investor. I know today was brutal. Watching an 8% drop in an hour triggers fear, doubt, and nausea. It makes you question your thesis. It makes you wonder if the banks are simply too powerful. But ask yourself this. If you sold today, who bought? The U.S. Mint didn't. Oh, they're closed. Retail buyers didn't. They're locked out by minimums. The buyers at $86 were the same entities that engineered the crash. The banks covered shorts. Chinese wholesalers filled cargo holds. Industrial giants topped off strategic reserves. They shook the tree and collected what fell. Do not give them your fruit. The great decoupling is a trap for weak hands and a gift for strong ones. If you hold physical metal, the screen price is irrelevant. Your ounce is still an ounce. And according to dealer reality, that ounce is worth $120. You are holding the only asset in this system with no counterparty risk. The fact that the U.S. Mint cannot price its own silver coinage is the ultimate signal. It tells you the dollar is losing its ability to measure value. When the measuring stick breaks, you don't blame the object being measured. You blame the stick. Silver isn't volatile. Silver is the anchor. The dollar is what's thrashing. So what should you do now? First, turn off the screen. The number you're seeing is a digital hallucination designed to extract wealth. Second, look at what you hold. Feel the weight. That is reality. Third, prepare for the pivot. Because while the banks were smashing the price today, something else happened. Something that could permanently change the silver market. At the highest levels of power, alarms are now sounding. A broken silver market is not just a financial problem. It is a national security threat. You cannot build missiles, grids, or defense systems with paper contracts. Governments understand that low prices destroy supply. And while the banks were fighting for lower prices, the government moved in the opposite direction. Today, President Trump signed a document acknowledging the strategic danger of suppressed silver prices, a document proposing a structural response, a document that introduces the concept of a price floor, not to cap silver, but to secure it. The banks are fighting for lower prices. The government is preparing to fight for higher ones. In the next breakdown, we will dissect this proclamation line by line. We will explain why it represents a turning point, why it signals the end of pure paper dominance and the beginning of political intervention. The banks may have won today's battle, but the war just changed. The cavalry is coming, and they're bringing price support, not suppression. The paper game is ending. The political game has begun. Hold fast. The real price is $120, and the government just realized it needs to go higher.